One of the parts of the new law is that you can now make IRA distributions for charitable purposes, that if you have an IRA and are at least 70 and a half, you can distribute up to $100,000 from that IRA to a qualified charity and not pay any tax on the distribution. It expires at the end of this year unless they renew it. But can you sort of hand walk us through how this works and who needs to think about it?
Yes, this is a really great provision. It first came in the 2006 Pension Protection Act. But basically, somebody who is over 70 and a half, and that means that they have actually passed their half birthday, it can't be just the year they're going to turn 70 and a half, who has to take a required minimum distribution, can have that distribution go to charity. The limitation is, as you said, $100,000. So only the first $100,000 of your required minimum distribution goes to charity. And so basically, the custodian will make the check out to the charity. So that the really good thing about this is that it does not increase your adjusted gross income, although you don't get a charitable deduction for it. Social Security benefits that are subject to tax may be lower. Your Medicare tax in a couple of years may be lower. If somebody is charitable but doesn't itemize deductions, they're still going to get the benefit by doing things this way. If somebody has a charitable contribution carryover, it's going to benefit them. So it's really a win-win situation. And so I think a lot of people should consider it. And it can be not only your own account, but one that's inherited, where you have a required minimum distribution.
So if it's inherited and you're under 70 and a half, you can also make this, or no?
You have to be 70 and a half and inherit an IRA. So that 70 and a half is the key point in any case.
Mike, Frank, anything to add?
This really wasn't something that a lot of my clients took advantage of over the course of the last couple of years, because the income and deduction were washing out. There was no piece limitation that was impacting the charitable deduction. So adding an extra $100,000 and deducting it was a net zero. But now that we have several different types of AGI-based increases in the tax rate, it is going to make a difference, and it will save them a few dollars if they go through the mechanics of actually distributing it directly to the charity.
Okay.
One other thing is that, we talk about the 100,000, but we want to look on the low side. If you ask your custodian to write $10 checks for 52 weeks a year for you to put in the collection basket at church, they might not want to do that. So I think that your custodian might have some limitations that they want it to be, not a tiny amount, but you don't have to give the whole $100,000.
Right, and it doesn't have to be to one charity either.
It doesn't have to be to one charity. Yes.
Okay. All right. So one of the new aspects of the new law also has to do with Roth conversions, and now folks whose employers offer a Roth 401k, I believe, and a traditional 401k can now make a conversion.
If the employer does offer a Roth 401k, I would strongly encourage individuals to look at that as a potential strategy. Now, that's not to say that you can max out the traditional 401k with $17,500 and max out the Roth, because you can't. They're combined. So you may want to take a portion of the amount that you're putting in your traditional 401k and allocate it to the Roth 401k. And then, of course, providing your income, or at least your income level allows, then you would also establish the Roth IRA. So I think it's definitely an opportunity to diversify one's tax strategy, if you will, between tax deferred and potentially tax free.
Would you recommend that people do a conversion from a traditional 401k to the employer
I
sponsored?
I have strong feelings about that. I had an employer who did offer a Roth 401k, and I thought it was great because I couldn't make a contribution to a Roth, but there was no $5,000 or $6,000 limitation within the plan, and so I thought it was very good to do things within the plan. But now this recent change says if you have a 401k plan, you can take existing funds in the 401k plan and switch those to the Roth portion of that same plan. Well, that's a Roth conversions, I think, are a good thing, but within the plan, it's a little messier. You can't do the recharacterization. I think it's just a little more complicated. I think it's neater to do a IRA conversion to a Roth or the whole 401k conversion to a Roth and not do it within the same plan.
And then, of course, one thing that doesn't go away is if you do the conversion, you still have to pay a tax on the distribution at ordinary
Exactly,
income
because
rates.
it's ordinary income rates, and so it does impact your overall tax burden.
And that's the painful part. That's the part that a lot of people see as the limiting factor to making the conversion happen. They are going to be out money. And while their 401k and Roth 401k statement will say the same amount regardless of whether they make the conversion or not, it's not until years and years down the road when they actually take the money out that they will see the benefit from the tax-free distributions. But they're out of pocket up front.
And that's an excellent point, because if you're nearer to retiring, maybe this is not a strategy in terms of converting. However, if you're just starting out or you've been in the workforce for a little while and you got 10, 15 years, 20 years before you actually retire, it might make sense to do something like that.
Actually, it brings up a point. Many people say that there's a break-even point around a Roth conversion, that at some point you won't recoup the taxes that you've paid in terms of either the investment earnings or the ability to not withdraw money from an account. Is there any thoughts around that?
The longer you have in order to enjoy that tax-free growth, the better it's going to be to convert. If you have a very, very short time horizon between taking a distribution now versus taking it later, it's probably not going to be enough time to recoup that tax.
Well, also there's kind of a tax bracket thing that, for instance, the 25% and the 28% brackets are very, very wide brackets. And with many of my clients, they're in those brackets while they're working, and they're probably going to be in those brackets when they retire. So they would not want to do a conversion that's going to put them in a higher bracket than the 28%. So you kind of have to look at the bracket creep, as it were, because you don't want to pay tax now that you would never pay in the future.